Global funds form the perfect core of an investment portfolio for many long-term investors. They offer instant diversification, they rebalance themselves automatically, and over the long term, a simple global fund has allowed investors to achieve great returns. With the global stock market, as measured by the FTSE All-World, delivering a compound annual growth rate of 10.12% over the past 20 years. Whilst we should always remember that past performance does not guarantee future results, it's easy to see why global funds have become so popular. However, whilst many investors know they want to invest in a global fund, picking which global fund to invest in has become increasingly difficult, with there being so many options to choose from and lots of small details to consider that are hardly explained wherever you go to look. So in this video, I'll go through how exactly I would go about picking a global fund for my ISA or SIP portfolio. Importantly, I'll be focusing on exchange traded funds in this video, as they're widely available on low-cost investment platforms. But a lot of these details will also be applicable to those who invest in other types of funds like OEICs, unit trusts, and investment trusts. This video is sponsored by Trading212, the UK investment platform offering zero commission investing. The information in this video should not be construed as investment advice or investment recommendations. Please always do your own research. Another note before we begin is that I'll be focusing on simple market cap weighted funds in this video, which simply weight companies based on their market capitalization. This is the most popular type of passive global fund, but if you're interested in other specialized global funds, check out my factor investing videos. I recently made a video on the quality factor, which may be of interest. So let's get right into all the things I would consider when deciding. But of course, remember that when investing, your capital is at risk and you may get back less than invested. Past performance is no guarantee of future results. The first thing you might notice when searching for a global fund is that there are so many different providers that offer them, and despite there being all this choice, the bulk of people focus on Vanguard. To name a number of the other largest providers you'll come across, there's the likes of iShares, which is owned by BlackRock, Invesco, SPDR, Xtrackers, WisdomTree, and many more. While some investors may be loyal to a particular brand, I personally do not really care too much who the fund provider is, as long as they are large and reputable. What matters much more to me is all the actual underlying details of the ETF, of which I'll go through many of those in this video. Whilst I do agree to some extent with the idea of global ETFs being commoditized, there will always be distinguishing details that investors need to consider to make sure they invest in the right ETF for them, especially since there can be multiple share classes and different listings of the same underlying ETF. It's not as simple as you can pick any and it'll be the best one for you. Okay, the first major thing I consider when shopping for a global ETF is what exactly I want my global fund to contain. Whilst you may think all global funds give exposure to the same markets, that's simply not the case. With an important point to note that many funds that at first glance may appear global may actually just give exposure to developed markets only. ETFs that track MSCI World are probably the best example of this. Take iShares Core MSCI World. As the name does imply, it's a global fund, but actually MSCI World is a developed market index consisting of 23 countries. You can find the full list of these countries on the MSCI website or the MSCI World Index fact sheet. It's up to you to decide whether you're concerned about the exclusion of emerging markets or not, but it is of course important to be aware of so you can make an informed decision. MSCI's index containing both developed and emerging markets is called MSCI ACWI, ACWI, with ACWI standing for All Country World Index. When browsing ETFs, it's important to check the key investor information document to see the index the ETF actually tracks, and then do further research on that index to see what it actually contains. Most ETFs tend to track indexes by FTSE Russell, MSCI, or Solo Active, and just like I said with MSCI, you'll be able to find further details on the index provider websites and index fact sheets. This links to the next point. As well as checking if it is a developed markets or all-world index, you also need to consider that not all index providers include the same countries in their developed markets and global indexes. For example, MSCI classifies South Korea as an emerging market, so it will not be included in MSCI World, whereas FTSE classify it as a developed market and thus it will be in their developed market index, FTSE Developed. This is important because if you then decide to mix and match ETFs in your portfolio later down the line, you may unintentionally miss out a country. This may not matter too much, but regardless, you want the breakdown of your portfolio to be intentional, not accidental. As with the example stated, mixing an MSCI World ETF with a FTSE Emerging Markets ETF would lead to South Korea being completely missed in an otherwise pretty global portfolio. The last thing to consider when checking indexes is whether they have any additional filters. Some indexes may not be a simple market cap weighted index, but actually tag on some additional filters that are not obvious from the name of the ETF that tracks it. The best example of this for me is the legal and general ETFs that I frequently see people talk about. The Legal and General Global Equity ETF with the ticker LGGG tracks the solo active core developed markets large and mid-cap USD index NTR net total return. So first thing to note here is that it is tracking a developed markets index, but also this index has additional ESG filters and excludes companies engaged purely in coal mining, production of controversial weapons, or consistently in breach of UN Global Compact principles. Again, I'm not saying whether this is a good thing or bad thing, I'm just saying that investors should be aware of this. So, to sum up this point, never guess what an ETF contains based on its name, and instead look into the index it actually tracks, because it may not be exactly what you thought it was. The next important point to consider is the currency that the ETF actually trades in. You should be able to check this on your investment platform by looking at the currency symbol next to the price when viewing the product. For example, on Trading 212, I have two Vanguard FTSE All World ETFs on screen here. Despite these funds otherwise being the same, VWRP trades in pounds, whereas VWRA trades in dollars. I'd always invest in funds that trade in the currency I use, so in my case that is GBP. By limiting myself to GBP trading funds, I'm avoiding paying any foreign exchange fees on transactions that can be costly, and there's no point paying them if I don't need to. This should not be confused with avoiding currency risk altogether though, as currency fluctuations impact your investments regardless of what currency a global fund trades in, as the underlying securities within the fund trade in many different currencies. I personally see it as I'm not in control of whether a currency will get stronger or weaker, so there's no point trying to predict it. However, I am in control of what currency I purchase funds in, so that is why I stick to GBP to avoid a cost that I know for certain will impact my total returns over the long term. Moving on, the next thing I check is whether an ETF distributes or accumulates dividends. This can be referred to as the distribution policy. Distributing means that dividends are paid out to you in cash, and you can choose what to do with them yourself. Whereas accumulating means any dividends are automatically reinvested within the fund, and this in turn pushes up the net asset value of the fund. The share price performance will reflect the reinvested dividends. When investing inside an ISA or a SIP for the long term, I personally always pick an accumulating option just because it's more hands-off, but to be honest, I think this really comes down to personal preference. If you're looking to maximize returns, you're probably going to want to reinvest all dividends anyway, so it's whether you want to do that manually or not. To find out if a fund is distributing or accumulating, your investment platform may tell you on the fund page. It may be immediately obvious from the fund title if it ends in ACC or DIST, or you can simply check the key investor information document to confirm. I'll now move on to look at the point that gets the most attention: fees. Keeping your costs as low as possible is vital when it comes to maximizing your returns, as the less you pay in fees, the more of your returns you get to keep, and the more you have available to compound. When investing into a global fund, there are two main categories of fees to consider: the fees that your investment platform charge you to buy and hold the fund, and the fees of the fund itself which apply regardless of which platform you use. For platform fees, you should look into whether there are any ongoing account fees. This may be a flat amount per month or a percentage of the value of your investments. You also want to see how much commission is charged on transactions, with this being super important for those who regularly contribute to their investments. And thirdly, I would take a look at FX fees if you do decide to invest into an ETF that trades in a different currency. Some platforms can charge their clients a fortune in FX fees, sometimes in excess of 1% of the value of the transaction, so you really want to be avoiding that. That being said, there are plenty of low-cost providers out there, and that brings us nicely onto the sponsor of today's video, Trading 212. Trading 212 in their Invest and Stocks ISA accounts charge no commission on trades, no custody fee, and one of the lowest FX fees on the market at only 0.15%. So you'll be able to keep more of your investment returns, and this makes it perfect for a long-term investment portfolio. Trading 212 offer over 13,000 stocks and ETFs to invest in, so you'll certainly be spoiled for choice when looking for a global fund or otherwise to invest in. I've had no trouble finding any of the developed markets or all-world ETFs on Trading 212 when I was doing the research for this video. There's also a number of innovative and handy features on the platform, and it is the pie feature in particular that I want to mention here. When you construct a pie, you can easily manage a multiple position portfolio by setting the weighting of each stock or ETF, adding or removing positions at any time, and being able to rebalance the weightings with just one click. What's more, as a viewer of my channel, if you sign up to Trading 212 via the link in the description, you can claim free fractional shares worth up to £100. All you have to do is complete the sign-up process, verify your identity, and fund your account with at least £1. Alternatively, once you've got the app, you can go to the settings page, scroll down to the use promo code section, and type in my name, Tom, to claim your free fractional share within 10 days of opening your account. As always, remember that when investing, your capital is at risk, and for the offer, terms and conditions do apply. Okay, moving on to the fees of the global fund itself. The main headline fee to consider is what is known as the total expense ratio. Check out my video on the hidden costs of ETFs for a deep dive into what exactly the total expense ratio does and does not include. But for the purposes of this video, the total expense ratio can be thought of as giving a good idea of the total ongoing annual cost of owning that fund. The general idea is that the lower the TER, the better, but it is definitely not the be-all and end-all. I will provide a couple of examples, but remember these are not recommendations. The ETF with the lowest total expense ratio may be inferior in other aspects or not be suitable for you. At the time of making this video, the cheapest all-world ETF that trades in GBP that I could find is the SPDR MSCI All Country World Index ETF, with the great ticker of ACWY. It has a total expense ratio of 0.12%, which is lower than the more well-known all-world options offered by Invesco and Vanguard. Their global ETFs have expense ratios of 0.15% and 0.22% respectively. The reason why you may not have heard anyone talking about the SPDR global ETF before is that they actually cut the fees only recently in August this year. Before that, the TER was actually 0.4%, so it has gone from being one of the most expensive passive global funds to actually now being the cheapest. I do believe that it will gain traction as more people become aware of it. After this, the developed markets ETFs with the lowest TERs are probably LGGG, SWLD, and VHVG. Whilst they are similar, these all track different indexes, and this will need to be taken into account, alongside other things, if deciding between them. Before moving on, the final point I want to mention regarding TER is how it is paid. A common question for beginners is when and how the fund fee is paid, and the answer is you do not directly pay it. The TER is deducted pro rata daily directly from the fund assets and not from your account, so you do not even know you've paid it. The share price of the ETF reflects the performance net of the TER. Okay, in order to avoid this video becoming too long, I'm going to quick fire through all the remaining things to consider. These are no less important, and be sure to check out my other videos linked in the description to learn more. Firstly, assets under management or AUM. AUM is the total market value of all the assets held by a fund. In other words, it's a measure of fund size. The AUM of a fund is usually higher if it has been out for a while and is popular with investors. You can find the most up-to-date AUM usually on the fund provider website. For example, the SPDR MSCI All Country World ETF currently has an AUM of $4.3 billion at the time of recording. Whilst a fund with a low AUM is not necessarily a bad sign, the fund size does matter to some extent. If a fund remains too small for a period of time, the fund provider may decide it is not worth them keeping it open and decide to close it. This does not mean that investors lose their money, but instead it may be a bit of a faff waiting for the fund to be liquidated or for assets to be merged with another fund. Additionally, funds with higher AUMs, although not always, usually have greater liquidity and more favourable bid-offer spreads. Liquidity refers to how easy shares of the ETF are to buy and sell. In other words, how long it takes for a buyer to be matched with a seller and for the order to go through. Orders for highly liquid ETFs will probably go through in seconds when the market is open. However, if you're selling a lot of a fund with a low AUM, it may take a while for the order to go through. Bid-offer spread refers to the difference between the buy and sell price. The greater the bid-offer spread, the more you'll be immediately down after purchasing a share. Investment platforms usually do not show this spread, but you can check it on the London Stock Exchange website, for example. You'll find for larger popular funds that contain highly liquid underlying assets, the bid-offer spread will be minimal, and investors probably do not even notice it. Next up, fund domicile. Just ETF is a great website for easily seeing where an ETF is domiciled by simply looking at the basic details tab. You'll find that, with some exceptions, most ETFs are domiciled in Ireland or Luxembourg. Ireland is usually favourable for investors as withholding tax on US stock dividends is only 15% compared to 30% for Luxembourg. Another point to consider is replication method. How exactly is the ETF aiming to replicate the returns of the index? This is broadly split into two categories: physical replication and synthetic replication. The former means the ETF actually owns the underlying assets of the index, be that all of them or a sample, whereas the latter means the ETF instead replicates the index by entering into a swap agreement with a counterparty. The counterparty agrees to pay the total return of the index in return for a swap fee and the returns of a collateral portfolio. There are pros and cons of both methods that are too long to go through in this video, but the majority of ETFs do tend to use physical replication. The final thing to consider once you've done your research and made a short list of global funds and you're comparing the performance is to ask yourself how useful it actually is to compare the performance. First of all, you want to be using a website that allows you to include dividends on the performance chart, like Just ETF, but also make sure you're comparing like for like. There is no point comparing the performance of a developed markets ETF to an all-world ETF, because of course it's going to differ. It's also important to remember that you're unlikely to spot any major differences when comparing like for like ETFs, and it is instead the many other aspects detailed in this video that are worth focusing on. Also, if a fund provider has changed their total expense ratio of an ETF since it launched, then looking at a past performance chart is of limited use. For example, in the case of the SPDR MSCI All Country World Index ETF, before August 2024, the TER was much higher, and it will have done a worse job of tracking the index resultingly. Therefore, comparing the past performance of ACWI to other global ETFs really is a bit pointless, as it should hopefully deliver comparatively better returns in the future given the fee cut. To conclude, it's probably fair to say that the global ETF market is now pretty commoditized, and investors are unlikely to make any majorly incorrect choices. However, it is important to know about all the small points discussed in this video, as together they are quite big, and following them ensures that you properly understand what you're actually picking and can pick the best possible global fund for you. Investors who rush into things without understanding may find out a year or two later they've actually only been investing in the developed world without knowing. They may not have considered trading currency and been paying FX fees, or they may have picked a distributing ETF when accumulation actually suits them better. The list goes on. For me personally, the best global ETF to hold in my ISA is one that has a relatively low TER, trades in GBP, accumulates dividends, domiciled in Ireland, has a reasonably high AUM, and a favourable bid-offer spread. I really like the increased competition in the ETF space now, as it's always a good thing for us retail investors. Last year we had Invesco launching a FTSE All-World ETF undercutting Vanguard, and then this year we've had SPDR undercut Invesco with their ACWI ETF. So fees do seem to only be heading in the right direction at the moment. That is it for this video. If you enjoyed it or found it helpful, then please consider leaving a like and subscribing for more investing content. As always, thank you for watching.